Hey everyone, thanks for joining. I really appreciate you waiting there. And I know it's coming close to Christmas, so I appreciate everyone giving their time. I'm assuming you're all very, very busy at the moment. I'll just get Daniel to hop on and join if he's there. There we go. Hey Dan, how are you, mate?
Yeah, good, Julian. How are you, mate?
Yeah, good, thank you. Sorry guys, to anyone that can, if my voice is a bit funny, I've been sick, so I'm only just kind of turning around that corner this morning. So hopefully that's not coming across too much of my voice, but just kind of wanted to take you through what we're going to be going through today. Obviously, if you've seen the title of the webinar, it's really around cash flow and things that you can do over Christmas to sort of set yourself off into the new year. I won't delve too much into Dan's talking points because he'll probably be pretty angry if I do that. But we've heard in the last year or so since kind of that COVID issues that we're all going to be meant to have been facing, and some of the issues haven't been maybe as bad as it was predicted 2 years or so ago. Everyone was really busy, and that's kind of continuing right now. But that kind of profitless boom has really been talked about a lot, where prices got driven up on materials, but everyone was working, and it was really around cash flow. I guess wasn't as much of an issue as it maybe it was thought was going to be, because everyone had so much work on that payments are just constantly coming in, and the payments are going out. The issue then was really, are you making profit on that? And is your business maybe being propped up from a financial perspective on just looking at your cash flow and thinking, hey, there's always cash in the bank, the business must be doing really well, and maybe not necessarily actually delving into what profit on those jobs and ultimately the business overall has been doing. I think as we move into next year, I think most of us know that that rate of work is not going to continue. It could never continue at that level anyway. So really now what we're going to have to start really focusing on is, obviously the profit has to be there, otherwise why in business? But ultimately, when those jobs start becoming more and more spaced out, the pressure on your cash flow is a lot stronger. So you really need to be in a situation where your cash flow can sustain your business. If you're running out of money, then your business isn't going to do very well. So that's kind of why we brought Dan and obviously the team at Xact Accounting, who we've done a few webinars with. At Build Xact, we really want to be trying to give you guys free advice, and free information where we can from people that actually know what they're talking about. I used to be at MYOB, and I used to deal with accountants and bookkeepers all the time. And one of the things that I used to always stress to people is find a niche, get good at it, and provide the best possible advice you can in that niche, and not just have manufacturing, retail, trade, the whole lot. So Xact Accounting sort of really specialize in that construction space. So you're getting really good advice from these guys when they do come on board and present. So I'll throw over to Dan to do a full introduction, but I just kind of wanted to do that, just sort of set the tone of what we're going to be looking at today.
Yeah, thanks, Julian. Really appreciate the warm welcome, mate, and obviously Build Xact, thanks for hosting as well. I mean, we have a pretty strong partnership with Build Xact. I mean, the software they use in the background is amazing. And I'll talk a little bit about what we do over at Xact Accounting, and particularly on the CFO advisory side as well, because a lot of the good work they do upstream, really sort of helps us downstream on the accounting side and sort of working out where the business is up to, especially when it comes to clarity and profit in your business as well. That's my space. So I'll touch on that in a little bit, but I might just jump in and share my screen if that's all right, Julian.
Yeah, awesome, mate.
All right.
Sorry, Dan, just to cut you off there, Dan. Sorry, mate. But one of the things I forgot to mention, guys, if you have any questions that you want to get down, I just maybe pop them down as we're going through the webinar, and then we'll do a Q&A section at the end and go through them all. But definitely just pop them in, and just make sure that you're selecting everyone when you pop them in on the chat. You can put them in the Q&A section as well, but sometimes I find the chat is a bit better in terms of just creating that dialogue conversation between people. So just, feel free to do that, but we will have a section at the end. If Dan wants to jump in and ask questions, answer questions during it, that's obviously completely down to him. I'll let him manage that. Otherwise, at the end, we'll cover it off. But sorry to interrupt you there, mate.
No, it's a really good point. I mean, everyone's time is really valuable. The sprint till Christmas. I guess the end of the working period, the sprint till Christmas, everyone's really busy. Definitely make the time of this. Shoot as many questions across as you want. Julie and I both carved out a bit of time for this. So definitely get some bang for buck out of this as well, above and beyond what we do. And look, yeah, I guess you have my details on here as well, Julian. It's probably scattered somewhere too. Yeah, send across a couple of questions afterwards as well, once you've had a bit of a digest and a play with the financial tool a little bit later on. But yeah, really good point, Julian. Thanks for shouting that one out.
All
right, so jumping into my piece, I'll do a bit of a brief introduction, and there'll be a bit of a brief agenda in this section as well. But a little bit about who we are. So we are Xact Accounting. So we're specialists in the building and construction space, and we label it as specialists in the built environment. And what that means is we pick up sort of builders as well, but we pick up sub trades, architects. Like I've got a legal construction firm that I look after as well, a couple of turf farms too. So anyone that in that sort of built environment, we sort of try and get across and try and help out where we can. So that is our niche, and I guess our area of expertise in the background. Look, to Julian's point as well, I mean, once you sort of grow and reach a certain size, it really pays to sort of have, I guess, top level, I guess, support coaches, whoever happens to be around you, that do sort of live and breathe the space. And you do get a lot of bang for buck out of that as well. Here at Xact Accounting too, so we are your traditional accounting firm, I guess. So we are a public practice firm. We have a couple of large divisions on the tax and compliance side as well. So we do your traditional tax returns, tax planning. We have a very, very deep understanding of QBCC licensing requirements, and we do have a little bit more in New South Wales and Victoria as well, and building that out too. We also have a division called CFO Advisory, which is the bit that I look after. So I don't have anything to do with the tax side. I'm I guess, on the CFO Advisory piece, and I'll talk about that in a sec. So I look after the CFO Advisory team here at Xact Accounting. So our reach as far as numbers and compliance and tax goes is pretty broad. But what is CFO Advisory? Unless you sort of like worked at, like, I guess, a really big business, or I guess firm, whatever it happens to be, I guess your typical CFO advisory accountant or management accountant, I guess they call it, commercial accountant, you probably would never have bumped into. So your tax guys are really interested in, I guess, tax and super and GST lodgements, looking in the rear vision mirror, really good around legislation, et cetera, and, that's sort of their space. My world is probably more the commercial space, and I don't have anything to do with GST. I mean, I can talk to it, but I'm probably a 3 out of 10. My world is more budgets, profit, what margin are you making? Are you hitting it? If not, why not? Yeah, and I guess that's sort of like executive level input into your business as well. So I'm all about the future, and is a business okay and tracking profitably? Hence why this whole cash flow piece has popped out, because this is the future and making sure the ship is going in the right direction. So that's my world, and sort of what drives us on the CFO advisory side too. So a little bit about us there. So what we're going to cover today, and again, please push through as many questions as you can. So I'm just going to quickly touch on the state of the market, and especially around cash flow forecasting, how that dovetails into that. I'm going to sort of walk through a live cash flow forecast example as well. So we'll go really deep with the tool. I'll probably skim over it for about 20 minutes, but this recording is available at the end as well. But yeah, definitely chuck a bit of time and effort at it, work it hard. And if you have any questions, definitely feel free to shoot them through at a later date. If you do work the cash flow tool hard and you have got some negative numbers in there, especially closing cash, it's all around cash this time of the year. Christmas time's fun for a lot of people, but commonly not for business owners. There is usually a bit of hurt. Claims sort of slow down. You still have to pay people leave and wages and rent and all the rest of it. I have got some solutions at the end where you can sort of lean on and flex on a little bit to try and get you through that Christmas period, especially if you can't get your cash flow to work. And finally, I just wouldn't mind just doing a bit of a sneak peek here around Xact Analytics, which is a bit of a dashboard we have been working on in, I guess, really close partnership with Build Xact, and it blends Xero and Build Xact data really nicely. And it's a strong bit of tech, so I wouldn't mind just giving that a bit of a flash at the end as well. So the reason why we're all here, if you're logging on, hopefully you're sort of logging in and going, well, look, cash is looking okay for us in the business, I guess, in the near future. But if you are a little bit stressed about it, you are definitely in the right place as far as getting some initial level guidance in the background as well. I just wouldn't mind just quickly touching on the year that was too. I mean, it's been a tough year, but it's probably been a really, really tough 2 years, to be absolutely honest. I mean, we ran this webinar about a year ago. COVID was, rampant, materials were just starting to rocket up too. Inflation sort of gotten away from us a little bit as well. And look, in my view, developers usually make money on the way up. Everything's going up, prices going up, land, et cetera, et cetera. But as the market's starting to cool, which is what I'm starting to see at the moment, I mean, builders have to sort of lift their margins and prices really aggressively. And nearly every single builder that I do with now that at least are on my books, all of them have had 1 or 2 bleeders that they've had to trade through just to get through and go, right, well, we've been hit pretty hard as far as margin goes. And look, if your margin's hurting, cash always suffers every single time. And now that, I guess that the market is cooling off a little bit, material prices are starting to taper off. Labor's still pretty aggressive at the moment, but I think that will be the new norm for a little while. But sub trades in particular are starting to cool off as well. Like I remember speaking to a builder, I think about 12 months ago, and they were saying a brickie was about $1.30 a brick. It sort of peaked at about $2.30, and now it is starting to cool off a little bit. And some of those sub trades are starting to reach out to builders and go, hey, can you sort of flick us a bit of work, which is indicating a little bit of cooling as well. So I think the more sophisticated builders will definitely make a fair bit of money as the market cools off. I mean, the project guys are probably in for a little bit of pain, so you do need to micro measure those margins all the way through, because as interest rates go up, mums and dads obviously have a little bit less money than I guess the more higher end professionals. So project guys are probably in for a little bit more pain, but the architectural design space, the reno space, now's the time to make a bit of hay, I think, especially if you are micromanaging your numbers, your margins, your cash. The year ahead, the next year and a half, giddy up. So I'll change gears now and go across to the cash flow tool. So bear with me just for 1 second. So this cash flow tool here, I mean, we are going to release this cash flow tool. So this is, I guess, a bit of a monthly planner. And look, if your numbers aren't too bad, you can get away with a monthly planner in the background. But if your cash flow is looking really bad, I'd highly recommend, I guess, using our daily planner as well. And I have had a couple of clients that have used a daily planner too, where cash is really wobbly, really thin. So look, I mean, I won't touch on the daily planner too much at this stage, but we will release it. And if you can't get enough transparency on your, I guess, monthly cash flow planner, definitely jump across that daily one. But for the purposes here, I'll step through the cash flow planner for the monthly piece, but you can apply those principles across your daily planner as well. And similar to exercise, guys, I mean, the more effort and energy you push into this, the more your numbers will stack, the more they'll hold water. Lean on your systems like Build Xact as well. I see builders build these amazing quotes and Build Xact all the time, heaps of detail. Purchase orders most of the time are in. Definitely lean on systems like Build Xact as well. Lean on those for like your creditor payments, I guess your direct costs, sub trades. Lean on those, you're invoicing out as well to clients and banks, etc. And you definitely help this hold a bit of water as well. Because if you are in a bit of strife for the cash flow period ahead, you want to make sure this is as right as accurate as possible. So this will be the tool that is released, obviously, at the end of this webinar too. There are some instructions in there. Have a bit of a read through, but I'll sort of just run through how this dashboard works in the background. So this is a pretty straightforward cash flow tool. It's really acute, really narrow. We only sort of look at the next 3 or 4 months. Traditionally, these would be, sort of like a rolling 12-month period, but anything generally outside 16 weeks is hard to cash flow forecast. And you normally do need a really strong budget, or at least some sort of forward-looking forecast to underpin the cash flow piece as well. But for a short-term cash flow, you can generally map these out pretty comfortably and pretty easily. But I'll run through this piece now anyway.
So Dan, just on that, mate, what's the ideal situation for someone to fill this out? Like, what, once a month, is it, or?
Yeah, look, I mean, depending on how dire the situation is, and again, this is the closing cash balances here. I mean, if you're in the red or you don't have like a buffer of 50 to 100K, I mean, I'd probably look at this weekly at a minimum, and just make sure that it's up to date. You're really comfortable with it. I mean, if your cash flow is getting close to monthly is fine, but again, if it is getting dire and payments and creditors and cash in is all over the place, and you just can't get a handle of it day to day, I'll probably revert to the daily cash flow planner in the background. But again, sorry.
And say I'm a builder that maybe isn't as great with the financial side of my business. Is this something I can pass on to my bookkeeper and say, hey, can you just fill this out as part of the services that we pay you for once a week or something like that?
Yeah, I believe so. Yes. I mean, your bookkeeper has a pretty good finger on the pulse as far as payments coming up. Generally they'll batch up your creditor, I guess, payments to your suppliers as well. You should be able to hand this across to your bookkeeper too. I mean, depending on their level of, I guess, of sophistication, how deep they are with you in the business too. But you should be able to hand this across to the bookkeeper and go, right, can you just break the back of this for me? Look at my accounts payable ledger. What's due now? Obviously, you'll forecast out 7 days, 14, 21, 30. You'll negotiate with yourself too which ones you want to push out if stuff is really tight. So you can get your bookkeeper to break the back of this as well. Just make sure that, I guess yourself as business owners and major stakeholders in your respective businesses, that you do look at this in a lot of detail. I mean, you'll be best placed to know what's going on in your business. Your bookkeeper, or I guess your accountant, or who you give this to, will have this much depth, whereas you'll have, I guess, a full level depth in the background. just make sure you do test the data, check it for reasonableness, see if it passes the sniff test. Definitely do put some time into this, because if you're on a bit of cash flow hurt, I mean, your business might be pretty profitable, but your cash flow might be really suffering. So there might be plenty of GP coming, but you'll have this big cash gulf in between. And if you run out of cash, it's like running out of oxygen. Your business needs it to breathe. It's super important. You have a good question, Julian. I mean, in these instances too, guys, I mean, depending on the business and the size too, I'm a big fan of lots of people in the tackle. So what that means is, sort of getting a better half or a wife or a husband to have a look at this, your bookkeeper, have a look at this. If you have a project manager as well, and they're sort of across your numbers a little bit, get them to sort of crap check this as well. Because again, I mean, depending on the size of the business, if you have sort of more than sort of 3 or 4 or 5 projects on the go, the business gets really noisy and you're just not across as much as you used to be either. If you have 1 or 2 projects, it's a bit easier. You can see materials come and go, wages, what's on the go. But if you have bigger businesses, I'd strongly encourage getting more people on the tackle and, reviewing this, even just week to week, if the numbers are looking a little bit dicey down the bottom here, super important, really, really important. As far as the dashboard goes, I've split this between numbers for those that like the analytics and also a bit of a visual graph. So up the top here, the big green bars here, so this is plotted month by month. The big green bars are all your cash in. The red bars are all your cash out, so you can get a bit of a visual as to what your cash is doing. And then this blue line here, this is your closing cash. So that should be the sum of the cash in the bank. But keep in mind that is including overdrafts as well too here. So as long as this blue line stays above this 0 line here, you'll be all right. But make sure you keep on reforecasting this out all the time in the background as well. Lean on your data and build exactly Xero, MYB, wherever the source data is, and just keep updating this all the time when you can. As long as the blue line's above that 0, you'll be all right 9 times out of 10. And as long as you put a bit of effort and energy into this too.
Dan, now, just on that, Dan, you mentioned the blue line over 0. So that's obviously where your worry line effectively is. Where would you say is the ideal situation, like in terms of a percentage of your revenue or something like that? Do you have any advice on that?
Yeah, so generally as a rule of thumb, and look, this conversation gets harder and harder, but particularly on the CFO advisory side, when I talk to my clients, we ideally want to have a bit of a war, I call it a war chest, which is usually 2 or 3 months worth of running costs, held in reserve. So basically a more sophisticated business that hasn't had as much damage from COVID, or they are trading their way out of it. They're not buying themselves any toys, but you want to have sort of 2 to 3 months worth of surplus cash sitting in the business that you don't dip below on. So if you're running costs for your business of 20 grand per month, you want to ideally sort of see 60 there, and your 60 grand is essentially your 0 line. But for those that are sort of running really tight and really close, these red numbers here, that's a big cause of concern. And we'll talk about levers a little bit later on. But this 0 line here means you're out of cash. That's a tremendous problem in the background. And we sort of need to talk emergency situation, what we can do and what levers we can pull to try and give yourself some cash flow space and a bit of breathing space, especially when you pop out in January, February as well. I mean, it's always going to be a nightmare coming up to Australia Day. Trades go slow. So again, the December period is one piece, but there is a bit of risk around January, and February is usually when the claims fire up again, or at least what I see anyway.
I think as well, there's always more of a chance that you have to pay an unexpected bill than unexpected money. I think everyone knows when the money's coming, that the bills sometimes are the ones that creep up.
Yeah, I mean, I had an instance recently with the builder. I mean, he thought that a job was finished. I mean, he used Build Xact, but he wasn't quite leveraging it all that well. He was a recent sign-on with me too. Got a bit excited. This is a few months ago now. Thought the project was done. Got excited. Had a bit of cash in the bank. Went out and bought himself a RAM, and he put a 20 or 30K deposit on it. And then I think literally about 7 days later, because this was 2 months after the project wrapped up, he got hit with a $20,000 air conditioning bill, which he just wasn't expecting. And he's already running pretty lean as far as his free cash flow went as well. So the moral of the story is, as long as you have good systems and processes in the background, you know exactly where your projects are up to, you have purchase orders in the background, you lean on your Build Xact system as well. Again, the quoting takeoff side is amazing. Why not follow that through for the job costing side? And as long as you're across there, you should be able to reasonably see with a high level of accuracy what cash outflows you have coming, especially in the short term, which is the whole purpose of this chat. So definitely lean on those systems and processes where you can. So coming on down here, so this is split up into 2. So this here is your summary of your cash in and out, your closing balances, and then everything below here is the detail So what we want to do here, so for the December end of month, we have our opening cash each month. And then when you go cash in and cash out, this will be your closing balance. And that rolls through into January, and then that rolls into February and March and so on. So this is a forecasting tool projecting out January, February, March in the background. So what you want to do here for your opening balance, and there's heaps of like little notes and tips all over the place. But with your opening cash balance, you don't just want to do your cash facility, but you also want to include your overdrafts as well. So if you have got an overdraft in place, 50, 100, 200, whatever it is, make sure you include that in here because we're trying to measure cash or free cash, available cash here in the background. So if you have $80,000 in one account and you have 100,000 overdraft as part of that, make sure you drop in $180,000 here as well. And there's no formulas sitting in the background, so you can just override this at the top. And then I'll touch on the cash in and cash out shortly, but this here is all your receipts in. So that's all your current projects, anything ad hoc that you might have on the go. You might still be receiving, external payments, I guess you might be tipping in money yourself to sort of help you through the period. So there's a whole different section on that. These are your cash outflows, particularly around creditors and your cost of goods. And I'll touch on that separately shortly. And then if you go, well, opening cash, plus your cash in, less your cash out, that's your closing balance. So just be a little bit careful with this as well. I mean, because this is capturing a pretty wide period. And commonly what I see, like if you do have payrolls week to week to week, you might have a pretty decent payroll, coming up to like the 27th or 28th of the month, but then you might not receive this huge cash in until the last day, which is those sort of 30-day terms. So the closing cash balance might actually get a bit lower than this. So let's be a bit careful going, all right, well, I've mapped it out for the month, especially if it is running really tight here, because that would give me a lot of concern because that is flying pretty close to the sun. Just make sure you are micro measuring, I guess those payments from the bank, credit as well, keeping the finger on the pulse and making sure you put a lot of effort and science into these two numbers here, which is cash in and cash out. So this is the summary, and then this is the number you want to keep under the microscope at all times. And if it gets really low, we need to work out what levers we can pull to try and get that better. So pushing on further down, so from here onwards, all the below feeds up into the summary piece. So with the receipts from customers, this is all the cash coming in from your clients, customers, the bank obviously making their payments, plus anything ad hoc on the go as well. So if we follow this one back, there's a whole separate tab here, which is your customer payments in. So if we go to customer payments, this is broken down into two sections. So the first section here, I commonly say to my clients, I want you to list down all your projects. You can name them however you want. Again, there's comments here all over the place, but list down your projects and put a bit of time and effort into setting this up. Because once you do it the first time, it's easier to maintain going forwards as well. But list down all your projects here. You can insert new rows in the background too. I mean, it's pretty hard to break this. And then just take a lot of time mapping out when you think those claims are going to go in. I usually find builders are really, really, really good at measuring when cash is coming in, because obviously that's the fun part. And we'll get to the outgoing side. So make sure that you do spend a bit of time going, well, are these claims coming in inside these months? It's really important to get this right because there's such a huge amount of cash coming in. We want to make sure that we get the timing right for this as well and map it out by projects. Don't try and lump it all in because then it gets noisy. The whirlwind will start for the week. You get to the end of the week. And if you have lots of projects on the go and if you're just being a bit lazy and putting against one, it gets really hard to track and manage. So similar to exercise again, the more energy you put into it, the more you'll get out of this. Another big tip as well is that make sure you include GST. I mean, obviously when we do profit and loss and stuff like that, you exclude GST because obviously that goes to the ATO. Just make sure you do put everything in here, including GST as well. Because obviously, with GST for the December quarter, you don't have to pay it till February. So basically you get to keep 10 cents in every dollar that comes in to help fund your business as far as cash goes in the background. So spend a lot of time here in this section inputting your cash in. So any of these blue cells here have no formulas. So you can go to town, change numbers, push them around, and that will flow through to this front section here. So for December, customer receipts, 245,000. We come back across here. It's a 210 plus these ad hocs give you 245. So that's how that floats through to this front section here. Usually in the background as well is these ad hoc cash payments. So you might have smaller renovation projects on the go. You might be sort of tipping a bit of cash personally or, drawing down against the house to sort of give you a bit of a breather. Put down all these ad hoc items in the background too. So you as a director might be going, well, loan from director. Look, I'm going to tip $100,000 in here to give me a little bit of breathing space in the background. And you can come back to this dashboard and go, well, what does that do to my cash? So you can see really quickly if you pull on some pretty big levers what it does in the front end. So I usually really do try and split out your core business, and then anything else ad hoc that's on the go in the background, definitely this is separately, because you want to try and keep these big payments under the microscope and make sure they do land where they land. So the 245,000 flows through to there, which is the sum of your cash in, which is really important. So be really, really diligent around this section. Have lots of communication with your bank, your clients. Don't just assume you're obviously because the claim is going through, you're going to get paid within sort of, I guess a couple of weeks, whenever the settlement date is. Keep them honest, keep communication high. If you're doing stage claims as well, make sure the QA, QS is all over it. There's no bumps or hits, because it's really easy for the bank to go, no, you've missed something, so I'm going to sit on my cash for 4 or 5 weeks, which could be devastating for a business, especially if your closing balances look like this. Because say, for example, you don't get that payment in and it pushes to January, there's a bloody big hole there. And then go, well, what do I do there? Well, I have to push out creditors, and that can create all sorts of noise and problems for you down the track, especially coming into Christmas as well. Everyone's going to be under a lot of pressure. Been a tough couple of years. So we want to make sure that, particularly cash in, with kids under the microscope, lots of communication with your bank and clients. The next unfun side is cash out, which is also equally important. So similar to this, or similar to the cash in, we want to follow the cash out and go, well, how's that looking? So similar to the cash in, we have this split between cost of goods sold or direct costs. And we also have overheads and other ad hoc items in the background here as well. So usually where businesses, I guess, can sort of stumble, and I really like to sort of split out COGS, direct costs and overheads, is I really like sort of keeping these separate, because overheads are usually pretty easy to map out. You have your rent, you have your telephone, your photocopy, whatever it happens to be. So that's really clean and really easy. Where you get a lot of bounce around, especially with cash out, is managing materials, contractors, sub-trades, etc., and then trying to work out how you're going to pay them sort of coming through the Christmas period too. So
Hey, Dan, if you wouldn't mind, mate, can you just go into a bit more detail about what separates costs, COGS versus overheads? People that don't know, I know you kind of give a few examples, but if you can give an actual definition of each, then that'd be great, I think.
Yeah, sure. No, it's a good point, Julian. So overheads in the business are things that don't generate your money. So it's your rent, it's your bookkeeper, it's people like me. I mean, I'm not on the tool swing and they have before you, so I'd be classed as an overhead. And that stuff's usually pretty easy to map out. I mean, you're going to have the same, the same weekly fee for your bookkeeper. You're going to have the same monthly payment for your rent. Separate those out and drop those in here. When I talk about direct costs or your cost of goods sold, so that's obviously a contributor to gross margin. These are the trades, materials, people that generate your cash. So it could be a plasterer, could be building materials, it could be a site supervisor for wages, whatever it happens to be. We have got a separate wage section in the background, but I would split out your cost of goods, because this is where you do normally get your biggest variability in your accounts payable. Whereas your monthly stuff down the bottom here just ticks along. So it could be accounting fees, legal fees, rent payments, etc. These here don't generate your money. These here, well, I guess these are a support service, but these here do generate your money. So if they're putting in, sweat effort, there'll be some sort of claim to be raised down the track. So I'd encourage you to sort of spend a lot of time up here, because this bit's the easy bit. Don't focus on the easy bit, focus on the hard bit, because this changes all the time. Because if you're getting a tremendous amount of cash in, and because builder margins are usually a fair bit skinnier, you're going to have a fair bit of cash going out as well. So definitely spend a lot of time here. Where to get bang for buck for this as well is, again, leaning on Xero, MYB, whatever your accounting system is. So look at your accounts payable and going, right, well, my accounts payable says I've got $400,000 due out the door. Have I mapped out that $400,000 here? If you haven't mapped out the $400,000 because you're sitting on a claim or there's a dispute or something, make sure you do try and reconcile this back to Xero. And where you can get even more bang for buck is if a job has been completed, by the plasterer, for example, but they haven't sent you an invoice, you should have an open purchase order sitting in Build Xact too. So look at your open purchase orders, look at your jobs that you have on the go currently, and lean on your systems like Build Xact, because it's pretty amazing. It gives you a lot of detail, especially if you have gone through a lot of detail and effort to put your quote together. You can lean on Build Xact to give you a lot of transparency around here. Because unless the invoice is entered in, and I guess you aren't across the purchase order process in the business, lean on Build Xact to give you a bit of a hand here as well. So really, really, really important, because it's the stuff that you don't know about. If you miss 20K here or 30K there, like with that air conditioning example, you can smash these numbers pretty quickly. So
on that, Dan, on that Paige, if you go back there for a second, it looks like just one or two bad months in terms of the cash in is really sort of screwing the business over there, because the cash out doesn't really, it actually drops in that February month, but the cash in is what's really caused the issue there, right?
Yeah, correct. Exactly right. I mean, cash outs, the cash in is usually a bit easier to manage. The cash out, you have got a little bit more wriggle room. But in this instance here, for this example, these couple of months here are right, but there's a bit of damage coming out, I guess, into February and March as well. And even this one here can be a bit precarious because obviously the bank switch off coming up to Christmas too. And what I sort of touched on before is making sure that these are as accurate as possible. But in this instance here, we've gone, well, if we pay our creditors on time, we still are in a bit of a cash flow hole here at the moment. So what are the levers that we can pull to try and get these into the black? And I'll touch on that in a second, Julian. But these, this line here is the number you want to keep under the microscope, and we'll touch on that very, very shortly. So we've touched on receipts. We've touched on creditors, because this is where the creditor line sort of sits here. So $151,000 going out in December. And so then that matches that number there, 151,000, which is creditors plus your overheads, the sum of those two of that. Now, this bit in particular in the middle here, these are like the big lumpy stuff, which goes to your business sort of week to week, month to month, which we have separated out. So we have got a separate section here on payroll. So do drop in your payroll items in here too. So don't drop in the gross wages. Keep in mind this is cash flow. So you might be paying someone $35 an hour, but they might only get 30, but they might only get 30 bucks in their hand. And obviously the $5 difference will sit as tax that you have to pay to the ATO down the track, which is like your pay-as-you-go withholding tax. So make sure that you just put in the cash impact here. Same with superannuation, obviously that's due on the 28th. So make sure you have a look at your balance sheet or whatever your processes are, chat to your bookkeeper and try and get a bit of a firm handle as to what that might be, because you don't want to miss that payment. The ATO comes down pretty hard on you if you miss these in the background. Work cover too. I mean, here in Queensland, usually get the first months, you get a bit of breathing space and then sort of tail end it for 9 months, the rest of the year. So map those out as best you can, because there's no stopping that wave, unfortunately. And then obviously payroll tax too. The Office of State Revenue wants to keep collecting their money. So do spend a bit of time mapping out your payroll costs as best you can. Again, chat to your bookkeeper or accountant, whoever it is, because you should be able to get some pretty decent level of detail around these numbers too, and update them if they change. If your wages are going through the roof in January because you need to do a heap of catch up or defects, ratchet this up so you get a bit of transparency around here as well. Constantly look at this. The next section is ATO payments as well. So anything big and lumpy coming in like BAS or pay-as-you-go withholding or income tax installments, make sure you do drop the numbers in here. Any ongoing debtor ratings as well, drop that in. Your BAS side is usually quarterly, so there is some basic, some basic pay-as-you-go withholding or pay-as-you-go income tax installments to the business. Just work through this methodically, and obviously apply as much science as you can. And then the big piece here is your loan payments as well. So we separated that out from creditors just because it can be a little bit messy, untangling, especially if you've got like a lot of loans, a lot of cash leaving the bank. So putting your shuttle mortgages, term loans, credit cards too, we've isolated that out because all the ad hoc items go against this, your Bunnings runs, whatever it happens to be. So just isolate those out as best you can. And look, I'd probably be a little bit more aggressive than conservative because you don't want to undercook these numbers and it gives you a false sense of security in here. Put in sort of worst case and then work backwards from there. Because if you drop in worst case and these are nice healthy numbers, giddy up. If they're not, then you need to go, right, well, how can we trim? How can we either pull claims forward so we are going to be all right at the end of this? And then down the bottom here, once you sort of add up all these cash out items, there's your $232,000 cash out for December, January, February, March. This comes up to the summary here, and this is the bit we want to keep under the microscope. So you've put in a good couple of hours into this. This does not look good. What can you do? So at the end of the day, I mean, if the business is generating profit, 9 times out of 10, cash will be okay. But in these instances here, there could be just a big delay with getting materials in, so you haven't been able to push through that last final claim, which could be really lumpy. It could be 10, 15, 20% of the build. And it is just a timing thing. So your profit might be okay, but it's just the cash. What can you do? So what you can do in the background here is, there are a couple of options. So we either try and pull cash in quicker, or we try and delay creditors and other items, and we do try and push those a little bit out. So what we can do to sort of help us a little bit is going, well, for these couple of projects here, is there any of this that we can bring forwards? And it's similar, like if you have forecasted out where your claims might land for, outside this period, have a good think as to what you can push forward as far as claims go. Hey guys, if we do an extra 10 hours worth of effort, across the cruise each week, can we bring some of these claims forward to try and help us through this period as well? Because we don't need a huge amount of cash to make sure we're okay in the background. And again, because the stage claims are so lumpy, if you can push through a bonus claim here, if you do sweat out a bit more effort, it changes the cash flow position really, really, really quickly in the background. So that is one option here. And I'll talk about emergency situations a little bit later on. But if you can pull these cash in items in, it does help the cash flow overall in the background there as well. The other piece here, and I'll touch on this a little bit later on too, is that do you have any other cash sitting around, sitting in an offset account against like a personal home or anything at all? Or, you could have some cash personally as a director sitting in there. You might be able to sort of chip in $100,000 here temporarily and pull it out once the Christmas period settles. Same impact. So that is one lever, is to try and pull this side, I guess, accelerate the cash in. The other piece to consider, obviously accelerating the cash in, is to try and push some of this stuff out. So when you come across your creditor payments, for example, are there any of these subcontractors here that you can negotiate with and say, well, look, instead of paying you $100,000 here, we're in a little bit of strike. Can we pay you $50,000 there? And then can we bump this up to sort of 60,000 and then sort of organize a payment plan in the background with them? And if you do sort of pull these payments down as well, and again, it's going to be a bit of a tough sell because everyone will have a bit of hurt from the year that was, it does pull these numbers around really quickly. I'd really, really encourage all of you, if you do have to go down this route and sort of push out either creditors or suppliers, have lots of communication with them, heaps and heaps and heaps. There's nothing worse than not getting a payment that you're hoping for, and it leaves you really short for, I guess, for your sub-trades to either pay for themselves or look after the family, or, pay their crews, guys and girls as well. So if you do have to push out these and you can't pull these claims forward, make sure you keep communication really high. I mean, you as a business owner, if the bank doesn't pay you because of one little QS or QA, I guess, defect, it upsets you. Usually you don't sort of find out till really late and you have to wait weeks. Just keep communication really high, particularly on this side. And the other side of it is I guess, looking at your overheads. Can you have a chat to your landlord and go, hey, can we get a rent abatement for a month? Or, can we pay you 2 halves here and then catch up that down the track? So make sure you do look at these and go, well, what negotiation, what leverage can I create in my business that'll give me a bit of breathing space? Because even adjusting that rent, you can see here, that it does pull it into the black a little bit as well, which is nice to see. Now, to help with a more strategic view of this, if you pop out this little plus sign here, we have some scenarios. So what I call this here are the levers. So this little micro window here is exactly the same as this window here. So say you put in all your cash, all your creditors, debtors, etc., and you're trying to work out which way do I go, which way do I try and get this into the black. We go, right, well, if we can push out our creditors or sort of lower our creditor payments by 10%, what does that do? So you can drop that in and it creates a bit of a what if scenario. Or if we can increase our sales by 10% based on the data presented, what does that do in the background? So this is the current cash flow here for the business. We know we're in a bit of damage territory here, but if we can either increase our claims by 10% over the next 4 months, what does it do? It goes, well, we're going to increase, and again, this is just real broad brush, just to sort of get the thought process going in the background. But if we can inject 10% more sales into the business and 10% more cash, we'll contribute in another $87,000 here and go, and then we go, well, this was our cash. These are our levers. What does that do down the bottom? And it's just to give you a bit of a feel for, if we can accelerate revenue or if we can push out creditors, what does it do? Well, actually, our cash flow position gets pretty good. And you can do a combination strategy here as well. So if you can't push out sales, go, well, if we can push out 10% of our creditors or, payments, whatever it happens to be, overheads, what does that do? So if we can save ourselves, between 15 and 13 grand a month, how does that compare to this? Well, it actually gets us pretty close to in the black. I mean, February is still a little bit of concern. And what happens when we sort of push that out to 15%? So if you're comfortable with these numbers down the bottom, and again, these numbers can change week to week depending on when your creditor runs are and when you get your payments in. Make sure you're constantly reforecasting this. But if we can save or push our creditors by 15%, or get that rent abatement, or if we can save these sort of numbers per month, again, you'll have to catch these up at some point, obviously, but we just want to get you through the Christmas period as well. If we pull on these levers, what does that do to cash? And again, it isn't a silver bullet process, but it's just to get the ideas flying and go, well, even if you do like a half strategy, what does that do? And you can start to build out, I guess, you can start to build out a few of your ideas, systems, processes, who you're going to communicate to, and I guess start to build out a strategy to support this. Because at the end of the day, I mean, we're talking cash flow here. We're not talking profit. We're just trying to help the business survive over the Christmas period. If you drop everything in. Sorry.
Dan, I was gonna say there as well, Matt. I think really what I'm seeing by looking at this is that the earlier we do this, the better we can in terms of pushing people out or changing things if we need to. Because I guess what you don't want to be in a situation of is realizing you're in a negative cash flow position, like happening next month. You want to kind of know roughly where you're going to fall over the next 2 months. I know it's hard to manage that, but the earlier you know, the better. To try and, like, if I know this now, and we're in, almost in December now, but if I know this in March, I'm going to have some issues, I can maybe start arranging things in my business, sooner rather than later. And, you've got some stuff coming up that are going to, some other levers that you can pull into a bit more detail. So having the most, amount of time that you can have is, obviously beneficial.
Yeah, you're exactly right, Julie. I mean, I know it's hard to sort of carve out a bit of time for this guys as well, but I guess you want to see the bus coming before it rolls over you. And again, if you can't make wages, it's a very, very, very uncomfortable position to be in. The guys and girls kick and scream and all the rest of it. And look, there's money stress is up there as far as one of the worst stressors I think a business owner can go through. And again, if you can't make wages, you've got a big crew, especially coming into Christmas. It's a really, really uncomfortable position to be in. So you do want to plan for this as best you can. So yeah, Julian, really good point, mate. And again, if you can be looking at this, at least weekly, and can continue to measure this out, at least you'll see the bus coming. You can start to plan for it instead of clenching and hoping.
Yeah, absolutely. Sorry to keep on cutting you off there.
No, you're right. No. It's good to sort of parachute out. Let's do a bit of a wrap here as well. So put as much science and effort into this as you can. We've talked about customer payments, cash in and cash out. Map out your projects, pull in anything ad hoc as well. It doesn't have to be cash generating items either. If you find that you are a little bit short here and you have got sort of 50 or 100K in an offset loan or something, think hard about it. Your mum and dad might have some money they can sort of chip you into, or a family member. Just drop that in as a separate line and, drop in the cash flow impact. Because all we're trying to do here, we're not trying to generate, I guess, measure profit. We're just trying to measure cash. And we just want to get you through the Christmas period as well. And we want these numbers to be as black and healthy as possible. Same with the creditors too, map out your direct guys, so I guess run through your accounts payable ledger, run through your build Xact too. I mean, that's where the source of truth is. If it's landed at zero, it means it's already happened. Build Xact gives you some, I guess, transparency as to what's going to happen and when the works have been complete. So lean on those systems and processes you have in the background to best map this out. Overheads are easy. 9 times out of 10, it's the easiest one to manage and measure. Your rental payments, just tick along. So make sure you spend a bit of time, because once you sort of set up this section as well, it's easy to stay on top of. And then pull this one under the microscope. Try and move numbers around where you can and go, right, can we get these numbers in the black? So I might just sort of change gears here a little bit now, because say you have pushed through this as best you can, you've managed this as best you can. I just wouldn't mind talking about a bit of, I guess, a few emergency planning items that you can do to try and stretch this a little bit further. And I'll talk about emergency planning and I guess some medium-term goals now as well. I'm just seeing that there's a question in there, I think from Megan. So a question I have here, let's go, different people put wages in different places. What do you recommend? Overhead or direct costs on the balance sheet? For the cash flow piece, it's a really good question. I mean, if you're a really good disciplined business, I mean, ideally you'll separate out overhead wages and direct cost wages in there. So I would ideally, I mean, as much as really, you can just lump the two into this one area, or if you feel more comfortable splitting them out, putting your wage overheads here And then in direct costs, so the guys or girls swinging the hammer or out on site, you can put them through as their own creditor line here. So you can put down, supervisor wage, or you can put down, I guess your carpentry gains in here. Just wherever captures all the cash pieces in the background. Commonly what I see with builders, before they sort of land in my patches, they just have wages as one line. So just put your wages there as one line as well. We don't want to overcomplicate this for you guys either. We don't want the tail wagging the dog. We just want to make sure we capture all the cash coming in and out. So there's nothing too strict to map this out. Just make sure it makes sense. Because once you sort of punch through December as well, and you get to January, and if this number's massively out, there's probably been some sort of forecasting error happen in the background, or we need to push claims around or creditors around as well. So you want this to be a bit of a measuring stick, because once you get to the end of December, if it's not close to that number, it means this isn't up to date and you've got risk coming. That's probably a big one. Yeah, so that's a good question, actually. So you've given the cash flow a really solid squeeze. You just can't make the numbers work. Your margins have been absolutely hammered throughout the year. And if your margins have been hammered, usually cash is pretty hammered as well. You could be in a bit of a rob Peter to pay Paul situation too, where you've got a couple of bleeders in the books, you just haven't traded through them yet. And obviously you've signed your next project, signed a large deposit where you can, and you have that rob Peter to pay Paul situation. What are some real big emergency levers that you can pull to sort of help you survive the Christmas period? The big one is ATO payment plans. So don't be afraid to lean on the ATO as a bit of a bank in the background. I mean, I know we've probably just passed the most recent VAS period, but there'll be as a pay-as-you-go withholding coming up as well. Don't be afraid to sort of lodge your BASs, get them in, your pay-as-you-go withholding, get them in, and then call up the ATO and negotiate payment plans. So back during the COVID period, I mean, there were some pretty large pieces, I guess, in the background where they were giving out 3-year terms with interest-free in the thick of COVID. Nowadays, now the dust has settled, they're being pretty ruthless with payment plans, but you can still get 2-year terms. Some of them attract interest, some of them don't. It just really depends on your history in the background as well. So if you have a 20, 30, 40, 50K BAS or pay-as-you-go withholding or IAS coming up, don't be afraid to pick up the phone and go, hey, ATO, can I negotiate a payment plan here? Even if it's over a year, I mean, commonly it's just the cash flow period over Christmas you want to get through. Coming into February and March, things free up, contracts start, fire up again, trades are available, people have come back from the Christmas break, and you've got a bit more breathing space. We're just trying to generate cash at this point, so don't be afraid to lean on the ATO as a bit of a bank there as well. 3 years is going to be really hard. 1 and 2 year payment plans will be a lot easier. If it's 1 year, you can generally get them sort of interest-free. If it's 2 years, it'll be a bit harder. But again, we just want to get you through that January, February, March period. And if you want to pay off that 1 year payment plan, you can once the dust settles as well. So that's usually a pretty big one you can lean on. Just another piece just to touch on there as well. Don't be fearful. If you are cash flow short and you can't pay a BAS or pay-as-you-go withholding, make sure you still lodge the IAS or lodge the BAS anyway. Get it in, make sure you lodge it in, because the ATO really don't like it when they can't see what businesses are making in the background. And the ATO are issuing DPNs at the moment, which are direct penalty notices, which is really bad if you get one of those. We have a couple of articles of that on our website, but you want to try and avoid those at all costs as well. So make sure you stay really diligent at getting those lodgements in. And then once you get the lodgements in, call up the ATO. And if you've been up to date with your payments and you haven't had lots of communication with them, you can get those payment plans through relatively easy, and that will free up a lot of cash in the background as well. Another really, really big one is to draw down on any loans. So I'm not just talking business loans here, I'm talking about personal loans. So if you have an offset or a bit of equity in the personal home, don't be afraid to sort of pull that down and tip a bit of money in, I guess, in the short term. Just be a bit careful with that too. I mean, you want to make sure the underlying business is profitable. So keep in mind cash is a profit. If you have a lot of cash in the bank, you're carrying large negative WIP, it's a bit of a dangerous territory to be in. But if you know the business is okay, you've got a bit of cash flow coming up over Christmas, don't be afraid to pull down on personal loans as well. If you have got a bit of equity in the home, I guess you have like a fixed rate loan or I guess fixed payments, you don't have the offset, have a chat to your banking manager or broker and go, hey, is it possible we can do like a small refinance or a small drawdown just to pull out a bit of cash in the short term, or, I guess pull money out of the offset and tip it in the business to keep you going. And then once you sort of get through the Christmas break, January, February, and claims are pushing out, pull that money back out and put it against the offset. But again, we're in sort of survival mode if you at that sort of level. Pull down what you can, tip it into the business just to keep you going. I know it's uncomfortable, and you'll get a bit more, I guess, have a bit of a high interest rate, or I guess interest payment on your personal loans. We are talking emergency situations here as well, so don't be afraid to pull down on that where you
Dan,
can.
Just on that, mate, I think Harry from Chocolate Money covered this a little bit at the beginning of the month when we did the webinar with him. I think he was basically saying just have access to the funds, so you can forgotten the term he used now, it's completely escaped me, but just having the money being available to take out, you probably know what the financial term is.
Yes.
And I believe you don't pay interest on it until you actually need to take the money out. So going through the process of having access to those funds, and then if you need to top it up last minute, you can pull 20k or whatever it is straight out and into that. And I believe you only pay on that 20k from my understanding, but
yeah, correct. Yeah, so if you have I guess an offset account, so a lot of people I speak to have like a fixed rate portion locked down, obviously with the interest rates back a year or two ago, and then some people have like an offset account where they sort of squirrel money away, but they can draw on it in emergency situations. You can have that money stuffed in an offset, and it lowers, I guess, your loan and obviously the interest payments as well. And so then when you take the money out and I guess pull it out of that account and put it elsewhere, that's when you incur the interest. But again, interest rates back a couple of years ago are pretty minor. I mean, unless you're sort of floating in the variable space at the moment, even then interest rates aren't too high currently when you sort of look at major historics back years ago. Don't be afraid of pulling that money to keep the business going, because commonly what I see with builders, usually the entire family's feeding out of it, the husband, the wife, family, everyone's sort of all on red. We want to keep the business going. And we are talking emergencies here as well. You just can't get the cash flow to work, you can't pull claims forward. We just want to sort of lean on whatever we can to keep the business going, during this really, really tough time. So don't be afraid to lean on those offsets, guys, and tip it in where you can. And if you haven't got an offset, have a chat to your banking manager or broker and to see what options are available. Probably have that conversation sooner rather than later. I'd highly recommend that. Should I answer a couple of these questions before I push on, Julian?
Yeah, that'd be great, mate. Yeah. So you've obviously answered Megan's one there. So Vanessa's asking, so is the idea to complete the forecast figures at the start of the month and then go back at the end of the month and input the actuals?
Yeah, so that's a really, really good point, Vanessa. I mean, what you want to do here on the forecasting side, and again, apologies for changing gears, guys, a little bit, is if you get to the end of December and this number here is 300,000, or sitting at zero, whatever it happens to be, you want to make sure that this opening figure up here matches. So you can either reconcile this to be exact, because if you have all your cash in and cash out down the bottom, you should be able to just grab that out of zero, MYB, QuickBooks, drop that in and reconcile this back. Because if you have a claim here that has come a little bit early and this is shot through the roof, you don't want to have that claim sitting here and giving you a false sense of security in the background. So it shouldn't change the overall effect. You just want to make sure that, from month to month, because you want to measure this sort of live almost, so at least week to week. If you're on the January, we want to make sure that opening balance there. So when you leave the 31st of December here and come to the 1st of January here, we want to make sure those two balances line up. So I probably recommend just doing the exercise and making sure that these reconcile in the background. Don't be lazy and just sort of put in 145,000 here, because then you're sort of getting away from the disciplines around a really good cash flow as well. If you're forcing the balance to be right, you'll get a bit of wobble with your AP, you get a bit of wobble with your accounts receivable as well. And it'll just make this process more and more difficult to track and manage. Yeah, so I would recommend, even just for your own discipline and learning, just going, well, this is what I plan to do. If this bottom number is wildly out, where was it different? Or, where's the money gone? So I would strongly encourage you to go through and put actuals in there if you can, just for your own disciplines. And you'll learn a bucket load from it, and you'll understand your cash flow better in your business. And it's good, and it's really good hygiene as well. Kirsty's given me another one too. So stage payment contracts are easy to track, but we do a lot of cost plus contracts, which is much harder to track. Any ideas? Yeah, so really good question around that. So with the cost plus contract, I mean, I'm a bit of a fan of those. I mean, it's reduced risk if material prices go up. And I know you have to give indicative sums, but it hedges the risk back towards the client as well. I mean, depending on, I guess, how you sort of schedule those out. I mean, ideally, you want to sort of push through cost plus claims, weekly, monthly, the sooner the better. I mean, because if you are incurring the cost on behalf of the client and you have your cost plus supply, which is, 20%, 30% market, whatever, then you push the claim forward, or I guess however it is structured. I mean, you want to, I guess, try and push those out as much as you can, because if you're stuck paying those suppliers and creditors for 30 days and the client's leaning on you for 30 days, then you finally give them an invoice and you go backwards and forwards and negotiate and say, yeah, that's right, that's wrong, or what's this invoice here? This isn't what we agreed. You can really sort of widen that cash flow hole in the background as well. So your margin and your cost plus position is protected, but it's a cash flow piece that we need to keep the business moving. So cost plus claims in sooner and earlier and be more aggressive with them coming into the Christmas break. It will give you a lot more breathing space coming into the Christmas period too. But Kirsty, the cost plus stuff is a bit more complex. I'm happy to have a bit of a chat with you afterwards, or send me an email and we can have a Zoom on that one too. But again, if you can push through those cost plus claims as frequently as possible, especially coming into Christmas, you'll ensure that the cash coming in is really tight and coming into the business. It'll give you a lot of breathing space here, as opposed to copying lots of costs coming out, having to wait 20, 30 days plus the payment terms. It can make these numbers here really wobbly.
Dan, if you can just pop your email into the chat, that'd be awesome in case anyone has to drop off, between that. I assume you can probably grab it somewhere. It'll be at the end, I assume, but just good for anyone else that does have to make a quick getaway.
Here we go. One from Peter as well.
I was about to say that.
So, So Peter, WIP, work in progress. Look, usually when I sort of bump into potential CFO advisory clients, even if they don't, sign up with us, I'd strongly recommend recommending that they get across two processes, which is work in progress, an absolute must, absolutely critical. If you guys haven't sort of looked at that before, I'd strongly recommend getting across WIP. We have another webinar on our website, which is all free and all the rest, so get across it. Super important. And then obviously job costing, which is super critical for the profit in the business too. So this is a little bit outside cash flow, because WIP isn't cash flow. It's more driven by profit. And I guess, is the business okay? Are the margins okay? As far as systems or programs that automatically calculate WIP, I could speak about work in progress for days. Actually, it's a bloody big area to get across. Xact can calculate it, but it relies on really, really, really good data. And if you have absolute rubbish data, Xact or reporting systems won't have much information for you, and it'll be really hard to calculate the WIP. So, as far as I guess a WIP automation system goes, we're jumping ahead a little bit, which is our Xact Analytics dashboard. So we have got a self-calculating WIP function in there that you can run at any date, but it really relies on really good data inside Xact for the Xact Analytics dashboard to work really well. So other systems that do WIP, no, but you can calculate it pretty easily as long as you have strong data in the background. So Procore, Xact, Buildertrend, all those can calculate it. But if you have really good data in Xact, you can calculate it relatively straightforward in the background too. So there is a whole separate webinar piece on our website around that, or feel free to send me an email and I'll just sort of send you over a calculator or tool to support that. But yeah, off the top of my head, no. I mean, I haven't had a look at data builder programs like that, but all the ones I've seen so far, they don't self-calculate with, but really, really, really important to be across. Thanks, Kirsty. Thanks for the note saying your email. Looking forward to that one.
I'm just noticing, guys, that there heaps of people have just joined in. Maybe there was an issue with time difference, because webinar started at 11 a.m. sort of my time here, but that's in Melbourne, that is. So hopefully, if you guys have missed the majority of that webinar, I do apologize, but it will be available on the YouTube channel later. So if you want to hop in and check, and obviously Dan's details are there. So if you have any questions, you can either reach out. Okay, so all right. Noreen mentioned there that it was told Brisbane time. So apologies if that was communicated that way. I'll look into that.
Yeah, no,
you'll get the link.
Yeah, apologies, guys, for those people that are just signing on in. Yeah, we'll have to have a look at that one maybe for next round. So pushing on through the emergency side. So again, drawing down on loans, can be really uncomfortable. I mean, obviously you worked hard to sort of put money into the personal home and the like, but we're talking survival here. So don't be afraid to pull on that lever just to keep the business going during that Christmas period. The other piece, don't be afraid to reach out to your bank and creditors and make payment arrangements. I alluded to that a little bit on the Cashflow tool before. Reach out to your bank. If you have like large loans on the go for vehicles or plant equipment, reach out to your banking manager, say, look, we just need a little bit of relief. We can push out a couple of these payments by a couple of months, catch them up in February, March, April when cash flow is a little bit better. But yeah, have those conversations sooner. The bank gets pretty upset, and the banking manager gets pretty upset, when you sort of stop making those payments or turn off the direct debits. It's the whole no surprise rule. If you give them a heads up, 9 times out of 10, they'll give you a hand. They're having these conversations with everyone everywhere. Hospitality, doesn't matter where you are. They're having these conversations a lot. And just be bullish with your requirements too. Back yourselves and say, look, we need this help, we need this relief. Don't say you're not going to pay it. Just go, right, go in hard with the negotiation. So it could be a $20,000 payment a month. Go, look, we want that waived. And then, commonly the bank will push back and say, well, give us something, land at 10 grand a month, and just reach a bit of a happy middle ground. But back yourselves in there and, just be really confident with what you're asking for. The other piece is having a chat to your creditors too. And I alluded to this before on the cash flow. Work out which ones where you have got a little bit of wriggle room. And look, some people on this call will like it, not like this. But again, we're talking emergency solutions here. Work out which ones you can sort of push back a little bit. If you have a huge claim that's coming for a plaster or something, it's the whole no surprise rule again. If you guys don't get paid from the bank, there's no explanation, you get pretty upset, but there's lots of communication in the background. Again, the no surprise rule, just have those conversations, go, hey, we've had a bit of a hard time. We want to pay, I guess you're really important to us. Give them lots of love. But, look, this is what I'm proposing. Again, go on there a little bit aggressive with what you need, and then always be pushed back and land on a middle ground that you're happy with as far as like negotiation 101 goes. But don't be afraid to have those conversations sooner. Don't wait until cash runs out and you have to stay on top of your cash flow, because it's a lot uglier then as well. Because a lot of your creditors, suppliers, sub-trades, they'll be relying on this money too. They'll be having the same conversations amongst themselves. If you give them the heads up, they can put into their own cash flows. Hey, this is a delay. What can I do downstream, down the track to help themselves as well? So have those conversations sooner rather than later. Don't be afraid to have them. There's 9 times out of 10 or 8 times out of 10, creditors are happy to have that chat. Worst case, it's a solid no. Best case, you get a bit of breathing space. The big one I see all the time is underutilized assets. So what I mean by that is you might have some formwork sitting around or an excavator sitting around. Use it once in a blue moon. It's collecting dust and collecting rust. Give it the flick. If you're not using it, get rid of it. I mean, unless you're sitting on a car, where they've sort of appreciated over the last couple of years due to COVID, give it a flick if it's not being used. Formwork or anything like that, get rid of it. It's not being used, or if any major changes coming in your business, just get rid of it and inject that cash in. Because the asset will be depreciating, will be collecting dust, collecting rust, and will be depreciating over time as well. Just get rid of it and pump some cash in. Medium-term solutions. So we've touched on the emergency, solutions there, and there are more, and we have dropped in quite a few more in the cash flow tool as well. If you do pop this out, there's a whole section down the bottom with a bit more detail. But just in the meantime, we have just talked about those emergency solutions here too. Now, if you have sort of traded through that, and we are looking sort of more medium term, so this is, your cash flow is looking okay. What do we do when the dust settles? I mean, this is just some good hygiene practices to do into your business, I guess, sort of every quarter, every 6 months. The big one here with managing cash is, and I see a lot of clients do this, is having separate bank accounts for different liabilities that are coming up. So when you look at your, I guess, when builders look at their bank accounts, and they go, right, well, I've had 2 or 3 major claims drop in. There's plenty of cash in there. Woohoo, that's awesome. But then it obviously disappears pretty quickly when you make your creditor run a few days later or the week later. And then obviously, once you sort of get to February, you're going to have that huge superannuation payment, which always pops out. Or sorry, January, when that superannuation pops out, the BAS pops out as well in February, and the cash vacuum happens pretty quickly. I really encourage clients, depending where you are on your journey, to have different bank accounts for different liabilities. So when you're making your wage payments to your, I guess, the guys and girls that are swinging the hammer, put some money aside into a separate bank account and call it superannuation, and put that money away each week or each fortnight, whenever your payment is, and just keep it separate from your core cash in the background as well. So I probably recommend having one for superannuation, one for BAS, and then one for your pay-as-you-go withholding as well, and just keep those funds separate from your main trading account. Again, cash disappears pretty quickly week to week. You just want to have any surprises when you get that big BAS bill. Oh, geez, I didn't know about that. But if you have a separate account there, at least you can sort of quarantine it and sort of draw a ring fence around and go, look, I can't touch that. I mean, lean on it if you need to during the emergency period, but it's just good medium-term hygiene if you can in the background, and just try and have separate accounts for that. The big one at the moment too is refinance where you can. So if you have some pretty decent planned equipment on, sort of 5 to 10 year loans, I mean, the interest rates might have been good, but if you need to sort of lower those week-to-week payments or month-to-month payments, refinance where you can. If you're sort of 3 or 4 years into the loan, I guess the loan repayments could have been 5 or 10 grand a week. push it out, refinance, have a chat to your broker, say, hey, can I push this out for another 10 years? It will lower your week to week, month to month payment. It'll give you a bit more breathing space in the business as well. So, I mean, you'll likely cop a bit of an interest rate hit there, depending on when you originally financed a bit of equipment versus now. But again, we're just trying to talk cash at the moment, just trying to talk about cash leverage in the business. So have a chat to your broker. If you are carrying decent loans of the business for PPE, definitely have a look at refinancing those where you can. So, and again, if you want to put extra money on it, you can just have a chat to your broker or banking manager or I guess leasing partner around that one. But definitely consider that, have a chat to your broker every 6 months, 12 months at a maximum around that. The other big one is, when was the last time you reviewed overheads? So again, overheads are like rent, photocopier, phones, et cetera, et cetera. I mean, my world is more focused around margin and making sure you stretch that out, gross margin and stretching that out where you can. But have a look at your overheads. You run through your bank statement, because you need to run through your bank statement to make sure that the overheads are correct. But all those direct debits that come out, whether it's for subscriptions or Netflix or, if you've got personal stuff buried in there, pull that under the microscope and go, what can we turn off for the moment? Give that a really good review and obviously sort of see where that money's going in the background. You could have surplus mobile phones in there that you haven't been looking at for a while. They're sitting in a drawer. Give those a review and obviously pull those apart and cancel them when you can, because you want to keep as much cash in the business as you can as well to make sure you're safe and the business can continue to trade. The other really, really big one as well is progress claims. So unlike Telstra and all the rest of them, where they get their sugar hits of $100 or $150 a month, from me and Julie and the rest, your progress claims are so lumpy and so chunky. If some of them are delayed by a few days or a week or whatever it is, it can be pretty devastating to business, especially if you haven't got a war chest in the background, or you haven't got a large overdraft, or you haven't got an offset account to draw down funds against. Make sure you're really, really up to date on those progress claims. Lots of communication to the bank, lots of communication to the QS as well, QA, and just make sure that those dates are locked in, because you don't want any unexpected bumps. I have a builder at the moment. He's working on commercial projects. He has 1.3 to $1.4 million claims per month. And you look, if he gets a couple of those knocks, he's had a really rough year historically. It blows a pretty big hole into his business because he has had a rough year. The balance sheet is in a bit of poor condition. We're trying to negotiate a finance facility in place for him or an overdraft. So just make sure you are really across that cash flow piece in the background, and the claims are up to date. And lean on Build Xact too. I mean, as long as you're disciplined with Build Xact on the claim stage, is what's been pushed out, what hasn't. Pull that under the microscope and just make sure you're really across this. So I guess the timing and dates of those two come in really, really, really important. That's it for the cash flow piece. I think overall, Julian, just one more piece I wouldn't mind sort of flash pending, unless you got Ethan, Chucky, and mate. I'll probably just quickly jump across to Xact Analytics.
We just had a question there, mate, and it's from Nathan. He's asked what percentage you recommend for each one. Would that be in reference to the triggers to pull? Was that maybe what that's in reference to?
Yeah. I mean, chuck a note in there, Nathan, if we're a little bit off pace. The idea of the percentages is going, well, and again, I'll just get back to the tool. In this instance here, if the goal is just to get this back in the black, or say you want to get this back to 30 or 40K, whatever it happens to be, you can chuck percentages in here and go, well, what does that do down the bottom? And it gives you a bit of a target as to how much cash you have to find in the background. So for example, if we put nothing in there, this is your original cash flow here. These are the numbers I care about down the bottom, because obviously you want to try and get these in the black. The idea here, and again, it's just a really, really high level scenario planner. If we can increase our claims by 10% or our revenue by 10%, what does that do down the bottom? And the goal here is to get this back in the black. Cool, we're back in the black. So when I look at this 10% line here, we have to go away and find $53,000 worth of cash flow. So in this instance here, we're going, well, this is our creditor lever. We need to either go away and negotiate with select creditors, or the creditors that love us, or the subbies that love us, and say, mate, you've given us a $50,000 claim. Can we push 15 grand out a few months, or can you put you on a payment plan out? So, I mean, the percentage fluctuates depending on how bad this line is. If these lines are all black, you don't even need to look at this, guys. Still obviously take the hygiene practices away around refinancing and ATO and all the rest of it. But if this is black, you don't worry about it. But if there's huge holes here, this number needs to be leveraged higher and higher and higher to work out what you need to do in the background. So the idea here is to play. Sorry.
He just clarified there, it was actually in regards to what to put away for super and bass.
Yeah. Apologies, guys. Sorry. So a separate conversation, maybe email me, Nathan, but I'm not sure how often you look at the balance sheets, but I sort of find the builders look at the profit and loss a lot, but never look at the balance sheet because it's a bit of voodoo. So your balance sheet actually tells you exactly what your BAS payment's going to be in the background. But keep in mind, at the end of the day, I mean, every invoice you raise out, say it's a $200,000 claim, you add your 10% GST on there, which is $220,000. That $20,000 needs to go to the ATO. And then when you pay creditors, you're obviously paying someone $10,000, add the GST on there, it's now $11,000. That $1,000 you're paying to someone else, so that lowers your liability. But long story short, if you pop open your balance sheet, and as long as it's up to date and everything's reconciled, you can look at your balance sheet and tell you exactly what your GST is going to be at any given point. Same as super, same as PageGo holding, it tells you exactly what that number is. So as soon as you pay someone, so for example, wages, obviously you pay them $35 an hour, you pay them $30 an hour in the hand, $5 per hour goes to this PageGo holding, which your bookkeeper looks after, or better half, whoever it is. You can actually look at your balance sheet and it tells you exactly what that amount is live, as long as it's reconciled and up to date. But flick me an email, Nathan. I'll give you a quick crash course or a 101 on balance sheets, because it does tell you exactly what you need to put away. So the percentage is hard. I mean, I'd rather use the exact amount and go from there. We have bounced around a little bit with this guy, so apologies for that. I thought it was worthwhile just addressing the questions while we go. Just the final piece, I just wouldn't mind flash painting a little bit. We've been working with Xact pretty heavily with this, and Julian has been instrumental in it, is that we are a bit of a tech business as well. So we've developed this dashboard, and it's powered by Xact and Xero, so we haven't got MYB or anything in there yet. We have a bit of a wait list for this, but basically it's a tool. So we use Power BI, and we created this dashboard, which sort of gives you amazing clarity on your business, and it sort of brings everything together. You Xero, you Xacts. You go, right, well, in amongst all the whirlwind, how is the business actually performing? And you get it on a dashboard. So it's a subscription service. We're releasing it slowly out, and we're just generating a bit of interest as to who wants to have a look at it. But it leverages off Xact, so your existing system leverages off Xero currently. And we are releasing this, I guess, to some more sophisticated builders as time goes on. But we are getting a bit of feedback from everyone, actually. So if you scan the QR code, there's another really short video as to what it does. But it really sort of supercharges, I guess, the visibility into your business, where your projects are up to, how much cash you're burning, how much profit you're burning on existing projects. Because at the end of the day, when you look at your bank account, you don't know how much of that is yours. If you haven't got strong job costing in the background, you go, well, which of my projects are cooking? If you've got a $600,000 charge out to a client or $500,000 build, you got $100,000 worth of profit. My world is, look, if you've got $10,000 for a retaining wall, it comes in at 10 grand as far as cost goes. I don't care. If it comes in at $11,000, we've cooked $1,000 a year profit. Well, now you're making 99,000. And it's that bit you want to sort of micro measure all the time. And this Xact analytics tool, which leverages off Xact tremendously. And as long as your data is good, you get some pretty powerful visibility out of it. So I just wanted to flash pan that one, guys. It's about sort of 6 months worth of hard work getting it up off the ground, and 12 months on, we're sort of releasing it out now. And that's me.
Yeah, guys, just to sort of add to Dan's last sort of closing statement there, I think it's really important. I think people sort of either preference cash flow or preference job costing to show your profit. Really, you want to be doing both. Like if you've got good profit in your business, you can probably pull a bit more triggers on your cash flow. If you're not doing any of the reporting, any of the analysis on that data, you can very easily end up in a lot of strife. Like I was at a Master Builders New South Wales event a few weeks ago. It was probably a couple of months ago, actually, now when I think about it. And there was a gent there that had just signed up to Xact a few weeks ago. And he said one of his friends who ran a building business was building a project about halfway through, didn't realize that the project wasn't profitable anymore, and basically just ran himself into the ground on the job and ended up having to close the business on it. And while he was building, he didn't think that there was any issue. And it was only after the fact that this happens. And look, I hear so many of these stories all the time. I'm at tons of different industry events and things like that, and people get up and speak about issues that they're having in their business. So, I'm coming from a place that I've heard it from builders directly. So just really take that extra time, and one of the things that we always say with our software is that if you end up using Build Exact, you're probably in a pretty good place of saving yourself time after using us, to the point that, hey, that 20 hours that I used to spend quoting, maybe I can just spend another 3-4 hours a month on actually really delving into, in depth my financial position. And, that will hopefully set you in good stead in the future. So, especially going into next year, there's been talk everywhere, work is going to slow down a little bit for some people. And, there's going to be less money in the economy because the government are trying to, pull as much of that out. They don't really want us spending a whole heap of money at the moment. They want us to stop spending. So there's going to be some issues there for people. So just really get on board that. If you've got some time, not to sort of take you away from your family over Christmas and stuff, but if you spend a couple of hours just doing it one evening or, during the day or something, that's going to help your business out massively in the short term and then into the long term as well.
Yeah, it's a really good point, Julie. I mean, it's been a bloody tough couple of years. I mean, we have lots of conversations with builders all the time, especially here in Build Exact. We're closely affiliated with Master Builders, HR, and a few others as well. And it's been a really tough couple of years. A few of the builders that I talk to now, heaps of them have sort of signed bleeding contracts. And what I mean by that is obviously materials and labor have been rocketing, and then they've been trying to raise those sort of fixed price contracts in the background. And commonly, sometimes, there's no margin that pops out of these ones that have been on the boil for a year or two. But what I'm seeing at the moment is, for the businesses that are sort of getting over the hump, trading through the bleeders, we're calling this the year of the balance sheet repair. And what I mean by that is, businesses are highly leveraged, lots of loans, usually carry a fair bit of ATO debt, but they've lifted their margins massively. So now we sort of need to go through a year of sort of trading super profitably, big margins, pumping in cash, because if you're generating massive margins and your overheads are under control, your cash reserves do build massively over time as well. But it's going to take a bit of time to trade through it. So usually about now, if not a couple of months, and I've worked with a few builders who've had to trade through it, you spend all the time micromanaging profit all the way through. As long as you're keeping that under the microscope, cash as a byproduct will always be okay. 9 times out of 10, you're ignoring, huge bad debts or collapses. If you're micromanaging your margin and you're sort of tracking that through, cash always gets better. And I can't stress that enough. But this cash flow piece, ignoring profit for the moment, we're just trying to trade you through, I guess, the short term.
Yeah, absolutely. And guys, like Kirsty's put in there, can you share the spreadsheets? So I'm not sure if you've got a link to that, Dan, to download it, or.
Yeah. When we send around the email to all the registrants, it'll have the link to our webpage. It'll have the tool that you can download. There'll be like a monthly planner and a daily planner. I mean, the daily one has a fair bit more detail on it, but reach out if you have any questions. But yeah, I mean, when we send around the email later to all the registrants, they'll have all the links and the like in there as well.
Awesome. And guys, that's I think Phil has just popped it in as well. I think, is that the link, Dan?
Yeah, so that's the link to our Xact Analytics page.
Okay, yeah.
Phil, if you're on, mate, did you want to drop in just the link to our webpage or the resources page? So there's a fair bit in there around WIP, job costing. It's all free stuff. It's a short, sharp webinar like this. Yeah, I mean, even if you get nothing else from this, obviously cash flow is really important. If you're not across WIP, I strongly recommend it. We have a tool on that as well. Yeah, thanks, Phil. Phil's just dropped in the detail.
Yeah, Kirsty, the link's there if you want to grab it. But guys, that's a pretty fleshed out Excel report that the guys are providing completely for free. So definitely go in and make use of that. And obviously, you want any further information, further help in your business, Building that to really behind the team at Xact Accounting. And not just because they've got Xact in the name. I always try and make that bad dad joke as I go. And then Jennifer and Noreen will Exact will reach out to you guys as well to get in touch about the software. Have we got any further questions, guys, before we drop off? I don't think so.
Great. Hopefully it was an effective one then.
Yeah, really good one in the lead into Christmas, because it's we want to focus on those kind of things rather than, winning work over Christmas, because, most people aren't doing too much of that process, I don't think. But yeah, guys, just to kind of delve into, thanks Sally, and thanks Ingrid as well. Just to kind of delve into, if you're not using Build Exact, my recommendation is generally either start a trial or get a demo of the software. Demo takes anywhere from 30 minutes up to 45 minutes, I would say, depending on how many questions you have. Obviously estimating, so you load your plans in, you do takeoffs, you generate a quote that we generate for you, professional quote. From there, you build your schedule out, and then all the information you've entered into your estimate, that comes into your job management process when you're ordering materials and cost tracking, which is what Dan was sort of referencing earlier on. So ultimately, you want to be seeing, hey, I expected to pay this, I actually paid that, what's that, and it has an impact on my business. And then as much as you can, take that information into your cash flow reporting tool that the guys here provided you. And that will give you a really good snapshot in your business so that you can go into the next few months with real confidence in terms of how you're going to end up. And it's one of the things that when I started Build Xact, everyone was really pushing on takeoffs, estimating, how do I win work, quote faster, which is super important still. But I think the expectation now in the industry is, hey, look, I probably need to be using some sort of estimating software. There's that sort of the mentality now. Now we're kind of getting to the point that, hey, you estimating quoting software is not really in that early adoption phase. We're in that maturity phase, I think, now. But most people realize they need it. Now we just need to get people job costing, because especially as time get harder, we're going to start seeing people run into some real issues, and you want to be as best positioned as you can to solve that. And do it as early as you possibly can as well.
Yeah, I think. Oh, sorry, I was going to punctuate that a little bit further. I mean, the unfortunate thing with builders, if you answer the fully across the numbers, it takes so long to realize.
You're just cutting out a tiny bit, Dan. It's maybe just move a bit closer and.
Yeah, sorry guys. The other thing with job costing and tracking and using Build Xact too is that with builders, I mean, when you sort of sign that contract, it's 12 to 18 months. And if you own job costs, I guess job tracking or job costing and Build Xact or Xero and MYB, I mean, it takes a really, really long time to realize a project's cooking, and then it gives you a smack a long way down the track as well, especially if you're not under the microscope either. So if you're under the job tracking and job costing and leaning on Build Xact and, aligning your quotes to your actuals in the background, I mean, I strongly encourage you to start introducing that discipline into the business, because you don't want to wait until it's too late. And it usually happens, towards the end of the build, you're seeing on that last claim to release out, but you still have your huge accounts payable ledger in the background. You only got a tiny bit of cash coming in. At that point, you probably cooked the contract well and truly. So you want to try and see that bus coming, and you go, well, what other levers can we pull to try and drive more profitability into it? Is it more aggressive variations? Do we need to sign another contract? Do we need to get a reno job on at higher margin to keep us going? Yes, so I'd really encourage us to lean on, I guess, the infrastructure that Build Xact has in particular to get some real transparency in the business.
Yeah, great point, Dan. All right, guys, we'll probably leave that there then. I don't think, Michaela, can you build a husband, watch it later? Yeah, so we're going to, hopefully, I've just spoken to one of the team as the webinar was going on there. Sorry if you guys saw me chatting. I was trying to figure out what the issue was with people joining in late. But yeah, we're going to hopefully try and get this link out in the next few hours or so. And yeah, that will have the full recording on there. But Michaela, maybe just the link should be on the email as well. But if you want to sort of save the links that are in there from Phil at the, with Xact Accounting, then definitely just save those links and you can access it straight away. But yeah, I think that's it by the looks of it.
That's a wrap. It's a tough year, guys. Tough couple of years. Be vigilant. Developers make money on the way up, which is the period we're sort of going through. And as the market cools, sophisticated builders, especially in the architectural design space, reno guys, now's the time to make hay. Lift those margins, keep them high. If the margins are good and you're measuring, I guess you're micro-measuring your business, you'll be all right. As long as you're sort of doing strong builds, leaning your data systems and processes, you'll be all right. But again, reach out. Julie and myself always have that bit of a yarn. Let's get through Christmas and make some money.
Yeah, absolutely. And guys, just one as well. I haven't done this before in a webinar, but useful to get feedback. Do you guys have any recommendations on what kind of webinars we can do in the future? Definitely feel free to reach out. I'll leave my email here just so you have it. But we're always looking at what kind of topics and webinars that we can do. So, you know, one that I was thinking maybe we could do is, you know, how to add more value to the quoting process in terms of maybe pushing your quote higher up in price and sort of saying, well, how do I make the client feel that it's not just about the lowest price? How do I add value in that thing? So that's kind of one of the ideas that I'm maybe looking at. We've got a pretty decent audience size that we can try and get people involved in. And obviously for people coming on and presenting in webinars, you know, they're trying to get their voice out there. So we can maybe attract some really good speakers into it, as, you know, Dan is one of the better ones in the world. Nice little plug for you, mate. But if you have any advice on, you know, things that you guys want to see, please feel free to reach out. We'll do what you guys want to see and we think you guys want to see. So any feedback would be really greatly appreciated. Cool. Yeah, I'll close it off there. Have a great Christmas, guys. Really appreciate you joining. And yeah, hope you have good holidays, and we'll see you again in the new year.
Absolutely. Thanks, everyone.
Thanks, Dan. Cheers, guys. See ya.
Bye.